silver situation here. Silver producer gross short positions at the lowest ever continued through the crash. War situation. I really don't know what's going on. I don't live in the Straits of Hormuz, and as the price spiked from about $25, $30 to $120, and now we're still at about $85, that is specifically when the amount of shorts went to the lowest ever. So as the silver price moved higher, their shorts got lower and lower and lower. This recession is going to be the mother of financial crises because there's so much credit in the system that's going to default, and it's going to lead to a bust of epic proportions unless they print trillions of dollars, which they will do, which will lead to hyperinflation, the death of the dollar, and gold and silver returning as money, and the end of the war, because there will be nothing to fund it. London spot silver is still more expensive than New York silver futures. Gold has gone from about 4,400, the low here after the crash. We hit a low of about 4,400 here. This is where open interest was at that low, 430,000. Let's go a little bit closer into the silver situation here. Silver producer gross short positions at the lowest ever continued through the crash. So we can see here, this is the black line, the net amount of net shorts. That's short positions minus long positions, and we're here at about 15,000. The only time we were lower than that in terms of net short positions was here in about 10,000 in 2019, when silver was about like 18 or 19 bucks. I think this was near the bottom of the silver market. And we can see here that these are the gross shorts on this line over here. And you can see I drew a black line to show you that we're at 19,000. We haven't even gotten close to that level of gross short position. So what does it mean? That producers are not shorting silver, meaning either they can't do it or they won't do it because they think the silver price is not worth hedging, or it's they can't hedge because it's too expensive, and they lose money that way.
When commodity producers stop hedging their own product, something unusual is happening in the market structure. As Rafi Farber points out here, silver producers' net short positions have dropped toward roughly 15,000 contracts, levels only seen near major market bottoms like 2019, when silver traded around $18 to $19. In normal cycles, miners hedge more aggressively when prices rise because it locks in profits and stabilizes revenue. If that behavior disappears, it raises questions about whether futures markets are functioning normally or becoming too expensive to hedge. For investors watching metals, that shift can hint at tightening supply dynamics. Next, Rafi Farber unravels why rising silver prices are actually pushing producers to reduce hedging instead of increasing it.
But if we focus in on this part of the graph, we can see that as the price spiked from about $25, $30 to $120, and now we're still at about 85, that is specifically when the amount of shorts went to the lowest ever. So as the silver price moved higher, their shorts got lower and lower and lower, and they are not building them back. You'd expect that if they want to hedge and when they want to lock in a big price, the producers, they would short more contracts at a higher price so they can lock in that price, but they haven't done it. Why not? Because hedging is impossible. It's not profitable to hedge at this point because London spot silver is still more expensive than New York silver futures. So hedging makes them lose money de facto. Therefore, they cannot do it. And that is one of the reasons why the silver futures market seems to be in a little bit of a breakdown.
A healthy futures market allows producers to hedge risk, but the moment hedging becomes unprofitable, cracks start forming beneath the surface. As Rafi Farber points out here, silver prices surged from roughly $25 to $30 toward triple digits, while producer short positions actually declined, the opposite of what traditional commodity hedging models predict. That disconnect suggests a pricing gap between London spot silver and New York futures may be distorting incentives for miners and traders. For investors, this matters because futures markets are supposed to anchor price discovery. When that mechanism weakens, volatility often follows. Next, Rafi Farber shows how gold futures positioning is revealing unusual pressure inside the metals market.
We can see that gold has gone from about 4,400, the low here After the crash on January 30th or February 1st, whatever it was, we hit a low of about 4,400 here. And this bar over here. This is where open interest was at that low. It was at about 430,000 or something like that. Now we are down to about 409,000. This says 411, but it's one day behind. I think the new numbers are 409,000. So basically, the gold price has gone from 4,400 to about 5,200. Now it's about 5,100. Still a big climb from 4,600. It's about $500. While open interest in gold futures has gone down from about 430,000 to 409,000. So we've had a big move up in the gold price, while open interest falls closer to the 400,000 level. If you have open interest going down and the price going up, that is the definition of a short squeeze. It doesn't mean that people are stuck, but it means that shorts are covering at higher prices on net. So we are once again in a minor gold short squeeze. So what is really happening on the planet? I don't know. I can just tell you that I hear rockets over my head every now and then, alarms and schmirens that warn me of incoming sirens, traumatized roosters, which is very upsetting.
A rising price combined with falling futures participation is one of the clearest signals traders quietly watch. As Rafi Farber points out here, gold climbing roughly $500, while open interest drops toward the 400,000 contract range, indicates that short sellers are closing positions rather than aggressively betting against the rally. That dynamic often produces short squeezes, where prices move higher, simply because bearish bets unwind. For investors, the deeper question is whether this represents temporary positioning pressure or the early stage of a broader metals bull market driven by macro uncertainty.
War situation, I really don't know what's going on. I don't live in the Straits of Hormuz, and I only have access to what everyone else has access to, with warped feeds on X and no trustworthy source of news at all. So, what is actually happening with oil? This is oil versus gold, oil priced in gold. So you can see here, we're still at almost record cheap levels of oil priced in real money. In other words, the problem here is the dollar. The problem isn't oil. The problem is that credit is being attacked here in the war, because what funds war? It's credit. Money doesn't really fund war. Credit funds war. The dollar is the main credit vehicle of the world, and it is clearly dying here because we see that oil is at 0.02. What is that? It means 0.02 ounces of gold can buy 1 barrel of oil. It has only been lower than this before the war started and during the lockdowns of 2020. That's it. Oil has never been this cheap before, ever. But for the dollar, things aren't looking so good. What about the very long term in oil? This is an interesting chart going back to 1860, going back to the war between the states. Yes, I use that term deliberately. We have here oil. It looks like this was before the war broke out. So I think we're up here now, like 0.02 something.
Sometimes the biggest market signal is hidden in the ratio nobody on television bothers to mention. As Rafi Farber points out here, when a barrel of oil costs just 0.02 ounces of gold, history tells us something unusual is happening beneath the surface. The last time this ratio even approached these levels was during the 2020 lockdown shock, when liquidity flooded the system and distorted pricing across commodities. Investors should recognize this isn't simply about cheap energy, it's a reflection of how global credit, largely denominated in dollars, finances wars and economic expansion. If that credit system weakens, asset pricing across everything from equities to commodities could reset. Next, Rafi Farber discusses why this historic oil-to-gold ratio reveals deeper cracks forming in the global monetary system.
A little bit of a spike that's not on this chart. Yeah, oil has gone up in price, yes, even in gold terms, a little bit, but really nothing big. Historically, it's the dollar that has the problem right now. So if you look at this level, we've only been lower in 2020 and in 1893. I don't know what was happening in 1893. There might be 1 or 2 people that were alive back then. Maybe one of them is in Japan. Maybe one of them is in America. I don't know. Are they like any 130-year-olds? There might be 1 or 2. We should ask them. I'm going to go find them. But the funny thing here is that since the 2008 financial crisis, Oil was at 0.16, now it is at 0.2. So it was 8 times more expensive back then than it is now. Let's move to the next chart here. Oil still near all-time lows versus silver as well. Here's the oil versus silver chart. So we're at 1.075 ounces of silver for a barrel of oil, or is it 1.075 barrels of oil for an ounce? It's basically 1 to 1, right? More or less. So the only time we were lower than this was during the lockdowns of sanity and love, and 1980 during the silver high of 1980, which means we haven't quite reached that. We're close to it in oil terms here, and it was what? It was like point 0.1. It was less than 1 a little bit.
Headlines talk about oil spikes, but long-term ratios quietly tell a very different story. As Rafi Farber points out here, when oil trades near 1 ounce of silver per barrel and just 0.02 ounces of gold, it signals that energy hasn't truly surged. Currencies have simply weakened around it. After the 2008 financial crisis, that same oil to gold ratio was closer to 0.16, meaning oil was roughly 8 times more expensive in real terms than today. For investors watching commodities, this raises an uncomfortable question. Are we witnessing an energy rally or a gradual erosion of purchasing power across fiat currencies? The distinction matters deeply for portfolio hedging strategies. Next, Rafi Farber talks about how this distortion spills into crypto markets and broader financial stability.
Yeah, in 1980 at the top there, oil is still very cheap versus gold and silver. It's the dollar that has the sickness. Bitcoin ain't recovering. There's no recovery in Bitcoin thanks to the war, despite the war. Maybe the war has nothing to do with it. I really don't know, but here's the trend line for Bitcoin versus silver. And we're below 800 ounces of silver per Bitcoin now, and we've broken the trend line, and it has not recovered yet. On the cusp of the final financial crisis, it will come. This is all employees, total non-farm payrolls, and you can see here that every time this curve has started to fall, we have a recession already in place. It happened in every single recession going back to 1960, I think even going back to the 1950s here, as this line kind of flattens out, as the slope goes it tops out and becomes horizontal and then goes negative. That's when the recession hits. And this recession is going to be the mother of financial crises because there's so much credit in the system that's going to default. And it's going to lead to a bust of epic proportions unless they print trillions of dollars, which they will do, which will lead to hyperinflation and death of the dollar and gold and silver returning as money and the end of the war because there will be nothing to fund it.
One of the quiet warning lights in macro markets is when employment trends flatten before anyone admits a slowdown. As Rafi Farber points out here, the historical pattern is remarkably consistent. When non-farm payroll growth stalls and the slope turns negative, recessions tend to follow quickly. The US labor cycle has followed this pattern since the 1960s, often months before equity markets fully price the risk. Add in the breakdown of Bitcoin versus silver, now under roughly 800 ounces per coin, and it suggests speculative assets may be losing momentum, while hard assets regain attention. For investors, that shift can signal a broader liquidity transition across markets. Next, Rafi Farber shows why the employment trend itself may be flashing one of the clearest recession signals yet.
Isn't that something to look forward to? Indeed. So we can see here that the slope has reached about even. It's horizontal now. There's no change in the ADP employment report. Or is this not ADP? I don't know, non-farm ADP. They all sound the same to me. So this is going to head down pretty soon, if not imminently, and it's going to coincide with the next recession. Whenever that hits, it's going to hit hard, and we're going to slam the pedal to the metal on the final printing round, and you know what happens next. Employment status for 6 months. So basically, this is a zoom in of this chart. Employment, same chart. Right, this is the horizontal slope that I referred to before. We have a high of about 158 million, 158.5 million employed total employment, and it's been flat since July. So that's about 6 months. This has never happened before. There hasn't been this long of a period of static employment report without a recession. This is Wile E. Coyote standing on air. I don't know what's keeping everything going, but it still seems to keep going, even though we are not moving and we have no momentum here in the boom cycle. This has never happened before. What has never happened before here?
Markets often ignore warning signs until the data stops moving altogether. As Rafi Farber points out here, total US employment hovering around 158 to 158.5 million for roughly 6 months is historically unusual without a recession following soon after. Since the post-war economic cycle began, periods where job growth stalls typically precede sharp slowdowns in corporate earnings and consumer spending. Investors watching Fed policy should remember that stagnant employment often forces central banks toward liquidity support, whether through rate cuts or balance sheet expansion. That response can push risk assets temporarily higher while masking deeper economic weakness underneath the surface. Next, Rafi Farber unravels why this frozen employment trend could be the setup for the next major economic turning point.
This is the unemployment rate. On the Fred chart here, you can see that every time that this rate bottoms, it starts to head up during recessions. Well, this is the very first time that the unemployment rate bottomed. I think it was like a year and a half ago, or maybe 2.5 years ago, or something like that. Actually, I think between 1.5 and 2 years ago. The unemployment rate bottomed at about 3.3. Now we're at 4.4, 4.5. We're heading up here. We're in this area here. And we've never bottomed and not had a recession before. It's the same kind of weird thing going on, but it's not going to last forever. This is going to accelerate, and we're going to see a huge amount of increase in unemployment, just like we do during every recession. I don't know what's keeping it going, but it's not going to last forever or very much longer at all. Here's another piece of evidence of that. Credit card, student loan, and auto loan delinquencies are all higher now than they were during the 2008 Great Financial Crisis. This is the percent of balance of 90 plus days delinquencies by loan type. So I drew these lines here. You can see this black line, this vertical line over here is the beginning of the 2008 financial crisis.
The labor market may look stable on headlines, but the direction of unemployment often matters more than the level itself. As Rafi Farber points out here, the unemployment rate bottomed near 3.3% and has already climbed toward 4.4 to 4.5%, a move that historically coincides with the early stages of recession cycles. What rarely gets mentioned is that every modern recession has started with exactly this pattern: a slow rise from extremely low unemployment before layoffs accelerate. Investors watching earnings quality should pay attention because rising joblessness usually compresses consumer spending and corporate margins at the same time. Next, Rafi Farber discusses why debt delinquencies are quietly confirming this economic stress.
And you can see the level of credit card debt over here was this. And if you draw the horizontal line over here, you can see that credit card rate delinquencies are higher now than they were during the breakout of the 2008 financial crisis. Also here, this is the red line. This is student loan debt. This was the abeyance or the suspension during COVID or something like that. And now we're back up to about 9.5%, higher than we were during the 2008 financial crisis. And this line over here is auto loans. We were over here somewhere between 0 and 5, maybe 3%. And you can see that this same green line, I think it's green or gray, so you can make fun of me later for it. It's not good. It's higher than we were during the 2008 financial crisis breakout period. So all defaults, not all of them, but most of the default levels or the delinquency levels are worse now than they were back then. We are headed into the bust, and a lot of debt is going to default, and that is going to lead to monetary stress, which will necessitate printing and the buying of all these kinds of debt by the Federal Reserve.
Consumer debt stress rarely shows up in stock market headlines until it's already too late. As Rafi Farber points out here, delinquency rates across credit cards, student loans, and auto loans have climbed above the levels seen at the start of the 2008 financial crisis. That's a striking signal because consumer spending accounts for roughly 70% of the US economy, meaning rising defaults can ripple through banks, lenders, and retail earnings quickly. Investors should recognize the pattern. When households begin missing payments, credit spreads widen, and central banks often step in with liquidity to stabilize the system. Next, Rafi Farber talks about why the silver market may already be reacting to these deeper financial stresses.